This week, earnings season is beginning in earnest with reports from the major banks. JPMorgan Chase, Bank of America, Wells Fargo, and Citigroup, along with two huge investment banks, Goldman Sachs and Morgan Stanley. Coming to earnings, there was some concern that the banks, which had rallied hard after Trump won the election, might not be able to cope with the action in the bond market. There was a fear that rising long-term interest rates might cool down the economy and do real damage to the financials. But it turns out Wall Street had nothing to worry about because we got a cooler than expected consumer price index report on Wednesday. And because the banks, well, they're all doing great. Now, I usually try to walk through these one by one, but because we got all the major financials in a single week this time, we're going to split it up into two segments, doing the national banks first and then the investment banks after the break. Why don't we start with JPMorgan, which got things going on Wednesday morning when it reported a just terrific quarter. Huge sales and earnings beat. All three of JPMorgan's major business units came in better than expected, but the biggest source of upside was their commercial and investment bank, which put up 18% revenue growth. I mean, come on, that's amazing. This was driven by a 49% increase in investment banking fees, 21% increase in markets revenue, and now, got to tell you, those are incredible numbers. A lot of people were worried about JPMorgan's spending, but we got a pleasant surprise on that front, too. The company's overhead ratio, that's their cost divided by revenues, came in below expectations of 53%. You always want to see that number lower. That's extraordinary. There was even some good news in JPMorgan's limited guidance for 2025 as the company raised its full-year net interest income forecast by $1 billion while keeping its 2025 expense guidance unchanged. At the same time, CEO Jamie Dimon said, quote, businesses are more optimistic about the economy, and they are encouraged by expectations for a more pro-growth agenda and improved collaboration between government and business, end quote. Oh, music to my ears. Overall, it was an incredibly positive update from JPMorgan, so it's no surprise that the stock then was up 8% for the week. Also, Wednesday morning, we got results from Wells Fargo, which I own for the charitable trust. Wells missed expectations slightly on the top line, but also delivered a large bottom line beat. Net interest income came in ahead of expectations, but non-interest income, meaning fees, were a little light. Still, Wells had some nice growth in investment banking fees, up 59%, as well as investment advisory fees and brokerage commissions up 15%. The bank did have higher than expected expenses, but also benefited from lower than expected net charge-offs and provision for credit losses, meaning their credit quality is terrific here. I love that. Very few deadbeats. Wells maintained its aggressive buyback. No, I shouldn't call it aggressive. I'd say incredibly aggressive buyback, repurchasing shares worth $4 billion in the quarter. That means last year they retired 9% of their share count. When you're buying back stock that fast, it's only natural to put up big earnings per share. Remember, after all, there are a lot fewer shares. On top of that, management gave a better than expected forecast for net interest income in 2025, and they talked about $2.4 billion in gross expense reduction. Another unheard of figure. Overall, what we got from Wells Fargo was good. Good solid result, which is all we needed for this bank. Still very much mounting a comeback. And that's why the stock rallied more than 10% this week. Given that Trump is expected to have a lighter hand on regulation, I bet Wells remains one of the best holdings out there. Speaking of comebacks, wow, Citigroup. It reported a solid quarter on Wednesday morning as well. Citi's now doubled from its low 2023 lows. Woo. And the company's stock spent over a year getting its act together while delivering steadily improving numbers. Now, their fourth quarter report represented another solid update. This was a nice top and bottom line beat. Citi saw growth in each of its businesses, and all but investment banking beat expectations. The biggest source of growth was sales and trading, up 36% year over year. That shocked me. Citi's costs remain under control, and their credit quality metrics were basically in line with expectations. But the highlight from the quarter, as I see it, was management's outlook for 2025, the best of all the banks. Citi gave the most forward-looking guidance of anyone, and almost all of it was positive. The revenue forecast for 2025 was fully above what Wall Street was expecting. They're guiding up for net interest income to be, quote, modestly, while reported expenses should be, quote, slightly lower. Yes. Credit losses should be in line with 2024 levels. As a bonus, Citi said it expects revenue growth to continue in 2026, and management announced a new $20 billion repurchase program. No wonder the stock popped. A $20 billion buyback is huge, even for a $150 billion company. Overall, it looks like CEO Jane Fraser is really turning this thing around. While I've been a little bit guarded about Citigroup after the bank did so poorly for so long, and I've been right, I will say this. This stock is by far, even after this quarter, the cheapest of the banks. So if the company can keep delivering solid results, and it sure looks like that they can, I think this one's got more upside. Finally, Bank of America reported yesterday morning B of A had a modest revenue beat and a solid earnings beat, and all four of its segments grew. And other than their assets and trading division, everything else beat expectations. B of A's efficiency ratio, that's a key measure of cost control, was slightly better than expected, but much worse than what we got, say, from JPMorgan. This is the nation's second largest bank in terms of expense control. It's still closer to comeback kids like Wells Fargo and Citigroup. Still, a better than expected result is a better than expected result. And I'm not going to quibble about this one, okay? 5-cent earnings beat. Looking forward, Bank of America's net interest income outlook for 2025 was better than expected. Their expense guidance was basically in line. Frankly, this was just an okay quarter from Bank of America. The miss from their sales and trading business was glaring, given that most of the other banks did incredibly well in that space. But there are also some underappreciated aspects to the quarter, like continued improvements to the composition of their investment portfolio. This has been a quiet, low-level risk for Bank of America since the mini banking crisis, but it never really became a problem, and certainly doesn't look like it's going to be now. Maybe this is all you need to know. The stock rallied more than 3% this week, but almost all of that came on Wednesday in response to the quarters from JPMorgan, Wells, and Citigroup, and not yesterday, Bank of America reported. So the bottom line of this group, looking at the four biggest nationwide banks, JPMorgan's doing great, Wells Fargo and Citigroup are in full turnaround mode, and Bank of America's doing just fine. All told, the industry's in terrific shape. I want you to stick with Cramer to hear about the gigantic profits of the investment bank. Bad Money is back after the break.
Coming up, Cramer breaks down earnings from his alma mater, Goldman Sachs, as his big bank earnings recap continues. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.